To be a top 1% retiree in 2026, our estimate is roughly $28 million for households in their late 60s and roughly $24 million for households in their early 70s. But if you're watching this with $2 million, $4 million, $8 million, do not tune out, because the top 1% number may be the wrong scoreboard entirely. Based on Federal Reserve data rolled forward to 2026, roughly $3.8 million in total household net worth may already put a retiree age household near the top 10% for ages 65 to 74. Not top 1%, but already top 10%. And once you are in that range, the question usually stops being, do I have enough? The better question is what I have positioned correctly for taxes, income, required distributions, Medicare premiums, and the surviving spouse years? That is the part the net worth headlines almost never explain. Hi, I'm Mark Fonville, certified financial planner and CEO of Covenant Wealth Advisors in Richmond, Virginia. At Covenant Wealth Advisors, we work with retirees and pre-retirees who have $1 million or more in investable assets, and the "am I behind" anxiety is one of the most common beliefs I am asked to talk somebody out of. So in this video, I'm going to answer the little question first. How much net worth makes you a top 1% retiree in 2026? Then I'm going to show you why that number is less useful than most people think, and why the real planning opportunity for affluent retirees often shows up before required minimum distributions begin. One quick definition before we look at the numbers. Every number I mentioned today is total household net worth. That includes investment accounts, retirement accounts, cash, home equity, business interests, real estate and other assets, minus debt. This is not investable assets only. That distinction matters. Now, a retiree with $3.8 million of total net worth may not have $3.8 million available to spend. Some of that could be home equity. Some could be retirement accounts. Some could be taxable investments. And some could be illiquid. And that is exactly why the scoreboard can be misleading. So here is the data framework. We started with the Federal Reserve 2022 survey of consumer finances, which is the most recent public microdata set for this type of household wealth analysis. Then we rolled those thresholds forward to 2026 using the Fed's Z1 household and nonprofit balance sheet data. That gives us a current estimate, not a precision reading, not a guarantee, but a useful directional picture of where retiree households likely fall today. With that caveat, here is the retiree wealth pyramid for households aged 65 to 74. The median household in this age band is around $525,000 in total net worth. That is the middle of the pack. Half have more and half have less. The top 25% line is somewhere around $1.4 to $1.6 million. So if you are in your late 60s with $1.5 million of total net worth, you are not average. You are likely ahead of roughly 3/4 of retiree households in your age band. Our projected top 10% line is roughly $3.8 million. That is the level where many people still feel nervous, even though they are already near the wealthiest 10th of retiree age households. The top 5% is much higher, likely in the high single-digit millions, depending on the exact age band and calculation method. And then comes the top 1%. For households age 65 to 69 line, our projected top 1% estimate is approximately $28 million. For households age 70 to 74, it is approximately $24 million. Do not treat that age band difference as a cliff. At this level, the data is noisy. It can reflect spending, gifting, mortality, cohort effects, or just sampling variation. The important point is the scale. The top 1% retiree is not just one rung above the top 10% retiree. It is a different planet altogether. Now, the gap from the median retiree to the top 10% is a little over $3 million. The gap from the top 10% to the top 1% can be more than $20 million. That is why the top 1% headline can distort the way affluent retirees think about their own money. If you are worth $3 million or $4 million, you may look at $28 million number and feel behind. But statistically, you may already be far ahead. The problem is not that you are failing to reach the top 1%. The problem is that once you are in the top 10%, the planning game changes altogether. So let me make that a little bit more concrete for you. Imagine a hypothetical couple. Tom is 65, Linda's 63. Tom recently retired from engineering and Linda is close to retirement. They have $2.8 million across IRAs and a taxable brokerage account, plus a paid-off home worth about $1 million. Total household net worth about $3.8 million. On paper, Tom and Linda are around the top 10% line for their age band, but emotionally, they do not feel top 10%. They feel cautious. They underspend. They worry that a bear market, taxes, healthcare costs, or a bad sequence of withdrawals from their accounts could derail everything they built. And that fear is not irrational. We see it all the time, and it's just pointed at, we think, the wrong target. Tom and Linda do not need to become a top 1% household to have a successful retirement. They need to know whether their $3.8 million is positioned correctly. How much is pre-tax? How much is taxable? How much is home equity? How much income will be forced onto their tax return later? And what happens when one spouse dies and the survivor has to file as single? That is the real planning question. Now, contrast that with the top 1% household. A successful top 10% retiree household is often built from familiar pieces: a paid-off home, IRAs, 401ks, maybe a Roth IRA, a taxable brokerage account, and cash. That is the shape of a strong career, disciplined saving, and good habits over decades. The top 1% retiree can look completely different. At that level, the primary residence is often a smaller piece of the picture. What tends to dominate is business equity, concentrated stock, multiple real estate holdings, and large taxable brokerage accounts. The wealth is not just larger, it is built differently. And that matters because different assets create different tax problems. When most of your wealth is in traditional retirement accounts, your tax problem often shows up when required minimum distributions begin. For many current retirees, that is age 73. For younger retirees born in 1960 or later, it actually moves to age 75 under current law. So those distributions are generally calculated using the prior year-end account balance and an IRS life expectancy factor. When much of your wealth is in concentrated stock, business equity, and large taxable accounts, the tax problem can show up in different ways. Realized capital gains, the 3.8% net investment income tax, Medicare IRMAA surcharges, liquidity constraints, and higher federal brackets. At the top, the silent partner, the IRS, takes a much bigger seat at the table. That is the part the top 1% headline almost never covers. A top 1% retiree does not just have a bigger balance sheet. A top 1% retiree often has a more complicated tax and liquidity problem. Now, here is a simplified example. David is 67 and recently retired after selling a controlling interest in a regional business. Susan is 65 and recently retired from a hospital leadership role. Together, they have about $28 million in total net worth. And that puts them near our projected top 1% threshold for their age band. But look at the structure. They have about $6 million in traditional pre-tax IRAs. They have about $11 million in a taxable brokerage account with $7 million of embedded capital gains. They have about $7.5 million in illiquid rollover stock from the company that bought the business. They also have 2 paid-off homes worth about $3 million combined. And they have a relatively small Roth IRA account and an HSA or health savings account. On the surface, that looks like total freedom, and financially, yes, they have more than enough. Their lifestyle costs about only $220,000 a year, however. Combined Social Security covers roughly $80,000, so their portfolio needs to produce only about $140,000 a year. On $28 million, that is about 0.5% draw on their total net worth. Running out of money is just not the central issue. The central issue is tax timing, liquidity, and the surviving spouse. So here's why. If their $6 million of traditional IRAs grows at, let's say, roughly 5% a year, those accounts could be around $8 million when required distributions begin. Using the IRS life expectancy table, the first RMD could be roughly $300,000. That is before Social Security, before taxable dividends, before any realized capital gains, and before any business-related distributions. Now, the RMD is not automatically a disaster, but it is income you do not fully control. You can choose when to do Roth conversions. You can choose when to realize capital gains, and you can choose how to fund spending. But once RMDs start, a portion of the tax bill is no longer optional. The RMD is the bill you do not choose. Roth conversions are the lever you choose to pull. That distinction really matters. And then Medicare premiums enter the picture. IRMAA is based on modified adjusted gross income, and it usually works on a 2-year look back. For 2026, the first higher premium IRMAA tier begins above $218,000 of MAGI for married couples filing jointly, and above $109,000 for many single filers. The top joint tier begins at $750,000 of MAGI. At that top joint tier, Part B premiums are roughly $690 per month per spouse, before Part D surcharges. So a Roth conversion, a large capital gain, a business payout, or an RMD spike can affect Medicare premiums later. Not always immediately, often 2 years later. That is why tax planning in retirement is not just about this year's tax return, it is about the chain reaction of events that occurs. So income affects tax brackets, income affects capital gains rates, income affects IRMAA, and income affects the survivor's tax picture. And for David and Susan, one more issue matters. $7.5 million of their net worth is illiquid. If a large tax bill shows up, they cannot automatically sell those shares on demand. The cash has to come from somewhere else. That is where the top 1% problem starts to look very different from the top 10% problem. But here's the twist. The top 1% couple and the top 10% couple are asking the same core question. Not, do we need more, but rather the better question is what we have positioned to produce reliable income, manage taxes, and protect my surviving spouse. Because the biggest tax shock often arrives after the first spouse dies. When one spouse passes away, the survivor eventually files as single. The tax brackets compress. The IRMAA thresholds are lower. The household may still have most of the same account balances, but now the income flows through a smaller tax container. And that can add tens of thousands of dollars per year in taxes and Medicare premiums in some scenarios, depending on income mix, deductions, capital gains, the state they live in, and the rules in place at the time. And that is not just a top 1% problem. It is also a Tom and Linda problem. Let's go back to their $3.8 million portfolio. Assume about $1.8 million is in a traditional IRA. If those IRAs grow at 5% for about 10 years, they could be close to $3 million by the time Tom reaches his required beginning age, which is likely age 75 based on his birth year under current law. A first RMD could be around $120,000, depending on the prior year end balance and the applicable IRS factor. Now add Social Security. Call it roughly $70,000 combined. Add some dividends and interest from the brokerage account. Suddenly, their cash flow income could be near $215,000 a year. So an important distinction, IRMAA is based on modified adjusted gross income, not simply gross cash flow. But they are close enough to the first 2026 joint IRMAA tier above $218,000 of MAGI. That one Roth conversion, one capital gain, or one unusual income year could really push them over. And if one spouse dies, the surviving spouse faces the single filer thresholds. That is why the $3.8 million household and the $28 million household share the same planning theme. Same problem, smaller scale, same window of opportunity. That window is the bridge years between retirement and required minimum distributions. For some retirees, that means the years before age 73. For younger retirees, it may mean the years before age 75. Those years can be incredibly valuable because the retiree may have stopped working, but RMDs have not started yet. Income may be temporarily lower, tax brackets may have room, Roth conversions may be more attractive. Capital gains may be easier to manage, and charitable giving strategies can be planned. And the surviving spouse problem can be addressed before it becomes urgent. That is the part most net worth comparisons really miss. A percentile tells you where you rank. A plan tells you what to do next. And one brief note for very high net worth retirees, estate planning still matters, especially if your household is near or above the federal exemption, or if you live in a state with its own estate or inheritance tax. But for many affluent retirees in 2026, the more immediate planning issue is not the estate tax, it is income tax design. So how much income will your portfolio force onto your tax return? How will that income affect Medicare premiums? How much flexibility do you have before RMDs begin? And what happens to your survivor? Those are the questions that actually change retirement confidence. So here's the answer to the title question. How much net worth makes you a top 1% retiree in 2026? Well, based on our rolled forward estimate, roughly the mid to high 20 millions for households in the 65 to 74 range, with the exact number depending on age band, data source, and methodology. But here is the more useful answer. If you are already somewhere between 1.5 million and $10 million, the top 1% number is probably not the number that should drive your retirement plan. The better question is whether your current wealth is arranged in a way that gives you more control. Control over taxes, for example, or control over income, or control over withdrawals, even control over Medicare premium exposure, and finally, control over the surviving spouse income. And that is where the planning wins live. not in chasing the higher percentile. The number you chase may not be the number you need. If this reframe clicked for you, I have one question. Which worries you more right now? Taxes, healthcare premiums, or spending too little? Comment with one word: taxes, healthcare, or spending. I read every one. And your answers also help me decide what to cover next. And by the way, if you are 60 plus with $1 million or more saved and you want to understand whether your investments, taxes, and income plan are working together, you can learn more about our process at covenantwealthadvisors.com. I also made a video right here that walks through the Roth conversion window, the same bridge years window both of these hypothetical couples are sitting in right now. That is the natural next step from this video. Investments, taxes, and income planned as one. And if this is the kind of retirement math you want more of, subscribe to the channel. Thanks so much for watching. I am Mark Fonville, and I will see you in the next one.